Hello and welcome back to this channel. And in today's discussion, we'll quickly be looking at some ways, some methods to trade with the Traders Dynamic Index, the TDI. If you've not seen my previous videos, I talked about how to set up the TDI on your mobile. I shared how to set it up both on your Android device and on an iOS device. So if you haven't seen that video, just go back and the channel, click on videos, you see those videos. So once you set up your TDI, then you can then learn some of these methods to use them to get some very nice entry into your trading, either you're buying or you're selling. TDI is a very great technical analysis tool. It's very great. It's very simple to use to plot the direction of the market sentiment. And as I've always said, it's always good to use these as more confirmation because price action is king. So use this as more confirmation with your price action and you will be very profitable. You'll be very profitable. Now, all traders can use this. Either you're a scalper, intraday trader, or you are a long-term holder, a swing trader. Everybody can use this. Now, it depends on which one you feel works for you. I'm going to share about 5 different ways to use the TDI. Some people use one, some use two. You can use a couple of them for more confirmation. Depends on which one suits you. Now, it's very important that I've shared a lot of setups on this my channel, a lot of patterns, a lot of strategies. Now, it's good to try and know them all, but I think it's very important if you can be a master of one, so you don't confuse yourself, or you can even know more than one, maybe one, two, three, and together use them for your confirmations. And I think because if you have the more confirmations you have for a trade setup, the more confidence you should have to go into a trade. Yeah, it's not just going to a trade blindly because of your sentiment. The market will always win you if you do that. So this might be a very long video, but I hope you stay tuned to the end. I'm going to show you some very awesome methods which you could use to trade the market using this awesome indicator, the TDI. So let's move on to the first method, which I tagged the the cross, the cross, how to trade the TDI using the cross. Now this is quite simple. Remember your setup on your TDI. You know we have this is what your TDI should look like. If you set it up, it should look like this. So it's just all you need to do now is to look at the green line and the red line crossing over each other. Now, it is very important that you flow with the trend. As I've always said, the trend is your friend. So it's good you trade in the direction of the trend. Do not try and swim against the tide. You get drowned. So basically, this is just trading the crossover of this. So basically, this is just trading the crossover in between the green and the red lines at all time. Now, in my last setup, I did mention if on your RSI, you can add another level because the levels you have is the 70 and the 30 level. Of course, you know the 70 is the overbought level, while the 30 is the oversold level. If you've not seen my video on how to use the RSI, you should see that because that's also comes in handy here. So you can add another level, add a level which is the 50, add 50 level, which will be in the middle. Now, how do you use that 50 level as well? Now, the yellow line on your TDI, it shows you the overall trend. It shows you the overall trend. So once the yellow line is below the 50, it means you're in a downtrend. If it's above it, it means you're in an uptrend. So in this instance, I'm going to use it as an example for the crossover. I'm also going to show you how you should trade this using the overall trend, which is the yellow line. So in this case, the yellow line is below the 50 level, so it's a downtrend. So you should look for opportunities to sell. And then we have a cross. The green line crossed over the red line. which happens to be about this zone here. So when this happened, you should have just simply gotten on a sell. Green line crosses from above, crosses the red line. You sell, and what happens next? Price comes all the way, boom, 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 boom. Sell. You'd have gotten a lot of pips on this. And then when do you exit the trade? Exit the trade when you have another crossover, when the green line crosses from beneath, it crosses back, it crosses the red line again. So you could have exit your trade at about around here. That was about the end of the day. So you got good pips. This must have been about 100 or thereabout. We can do the math to see the number of pips that this would have given us. So basically, that's how to use it. Or if you didn't want to exit on the crossover, you can secure your trade, put your stop loss in profits, and let it ride. So that's about it for the cross. So this works this way, or it also works the other way. You can also see when it crosses from below, when the green line crosses the red line from below, you could have gotten in on a buy, and then boom, it goes up and exits when it crosses over to the other side. So you could have exited around here. You still would have gotten some good pips and be profitable. That's about it for the cross, and we'll quickly go on to the next how to use the dynamics index, which I have titled the yellow reversal. Remember, I said the yellow line is the overall trend, is the overall trend, telling if it's the downtrend or an uptrend. So this particular method, it's I highly advise it to be used on the higher time frames, the H4 and the D1 daily time frame. Now you use it. So my network keeps going off and on. So sorry about that. So you use the overall trend, the yellow line. You wait for it to push outside the overbought and the oversold zone. This happens very rarely, but when it does, it's a very good setup. It's a very good setup. And being on higher time frames, even if you have 3 or 4 candles, you're going to have a lot of pips because it's on a very high time frame. So let me use this as an example. The yellow line in this case, you probably won't be able to see it properly, but you can go to your own chart and look it up. This is GBP against the US dollar. You have this happens. The yellow line crosses and gets to the oversold zone. You can see it here. That's 30, crosses over to the oversold zone. And normally when this happens, when price shifts to this zone, it is only normal that it goes back to the normal zones, because these are oversold and overbought zone. So once the yellow line is on this zone, you could get in on a buy when a crossover happens. Now, as I said, all some of these methods are also intertwined. So if you look, the crossover had already happened. So right here, when the yellow line is just at the edge, have gone beyond the 30 zone. So it is, the overall trend is oversold. So you're getting on a buy, and boom, what happened? That was around here. Price goes all the way up. But this is a daily time frame. So each of these movements would have been a lot of pips. So, and then you exit when the crossover happens again. So when the green line crosses the red line from above, you exit. So you must have exited the trade around here, and you will be fine. So that's how to use the another method called the yellow reversal. So quickly, well, I want us to do a quick task now. I'm sure some of you that have been on this channel for a while, or those of you that are new seeing this video first, let's quickly run into a quick task, and I promise it'll be very beneficial to you. So just quickly hit the like button and also subscribe to the channel, and you're going to have yourself a very awesome years ahead to come. Try it. It works. So on to our discussion. So the next method is the squeeze. The method to trade using the TDI is the squeeze. Another method. Now this happens when you have when the market is ranging. When the market is ranging, you can see here in the price action, you have a range. You have a range. So what happens is, how does the TDI react to this range? The Bollinger Band, which is the upper bound, limits the upper and the lower bounds. Remember, if you set up your TDI, you'd have inserted a Bollinger Band. Now, these boundaries, they compress in times of a consolidation. It compresses. Now, what happens when they compress? It is most likely that the trade, even in a breakout, you know, when you have a consolidation, when you have a range, your sure price is going to break out to one side. So this is a very awesome way for you to know when it breaks out, if you should get in on that trade, or if it is a false break. So very simple. What happens? This example, when you have a range, you have a consolidation, the Bollinger Band squeezes, and then you have this happens. You have a breakout to the downside, and then you wait. When you see the green line has crossed over outside the Bollinger Band, you can see at this zone, at this very zone, you can see it breaks out of the Bollinger Band, which is around here, because it breaks out outside the Bollinger Band. So you can get in on a sell, and this is a daily time frame. So this would have been a lot of pips. So you sell, and then what happens? You exit that trade when it crosses back into the Bollinger Band, which happened around here, which is around here. So when I did the math, I did the calculation for this, the pip count was about 263 pips. So imagine for a 0.001 lot size, you'd have had $26 for this movement. So this is another very awesome strategy. Very simple to use. Wait for the breakout to happen. Look at your TDI. If there's a close outside, if price has not started trading outside the Bollinger Band, get in on that trade, and then you hold until another cross happens, which is this, and then boom, you would have gotten a lot of pips because these are on the higher time frame. So that's it for the squeeze. So let's quickly go on to the next method to use the TDI, which is the divergence. I talked about this when I shared a video on my channel called the RSI cheat. But now you can also use the TDI to spot some certain divergence. What is divergence? It's simply a disagreement between the price action here and on your TDI and your indicator. Now, when your price action is showing a different direction of movement, but your RSI is showing, your TDI is showing a different movement, getting on the direction of the TDI. For example, this happened this week. Today is 9th of August. This happened, I think, on the 7th of August, on Thursday. Most reverse had happened on Wednesdays and Thursdays. So some of us caught this on our Telegram group, and congratulations to those that caught this move. So what happened? You have a higher formation. You have this high, and then price comes down, and then price comes back up a bit higher than the previous high. So you can call this a double top formation. The price is higher than this previous high. But on your TDI, there is a conflict. You can see this formation, this here is higher, while this on the price action is higher, but on the TDI it is lower. So this is a clear divergence. And then look, let me show you. Remember, I said it at the beginning of this video. You can use these things intertwined. You can use them. So if you look in very well, you zoom in on your chart, you see that you had a cross. You see that the cross happened. The green line crossed over the red line, and that happened exactly at this point. So you could have gotten in on a sell, and boom, price fell about 200 pips. So you would have gotten some serious pip if you spotted this on your TDI. So there's a lot of other divergence aside from this. This now is a bearish divergence. There's also a bullish divergence. If this were to happen around here, I don't have a screenshot for that, but I'll try and explain. If you saw that pattern, maybe if you look at your chart, look at USD against the Canadian dollar, or look at the USD against the Swiss francs. Perfect example. You see below, you see that you have. Let me see if I can use. Let me draw. This might take some of our time. You have something like this. This might take our time. I'm going to leave this. So you're going to have a W formation on the low of the USD against the Swiss francs. But if you look at your TDI, you see that it is the second leg is actually higher than the previous low. So that was a clear divergence, and you would have gotten on a buy, and you would have made some good profit. Look at it on your chart. If you do not understand this, what I just explained now, for the bullish divergence, you can leave a comment in the comment section, and I'm going to respond to you. We might probably talk. If you want to reach out to me, I'll send you the link to join our group, so we can share more ideas and or make you understand that better. So as I said, I just use this as an example. This is a bearish divergence. We also have a bullish divergence. In that case, the TDI will be pointing up while you have a lower low. So let's move on. Also, there's a hidden divergence, which is unlike this regular divergence, which is a reversal pattern. They are reversals. The bullish divergence is a reversal pattern. The bearish reversal is a reversal pattern. We also have a hidden divergence, and that is a continuation pattern. I took this screenshot on the euro against the Japanese yen. You have this low higher than the previous low, but on the TDI, it's in disagreement. You can see this one is a bit higher than this one. In this case, you would have bought, unlike the reversal patterns that is the other way around. So for a continuation pattern, you trade in the direction in which the price action is facing, not the TDI. So I hope you understand that. That's basically a hidden divergence. Now, in this case, it's a bullish hidden divergence. You can have the same thing for a bearish market where you have it facing down. Here on the TDI is facing up. So that's it for hidden divergence. If you don't understand, please do not hesitate to ask questions, and I'm going to respond to you as fast as I can. So on to the last method to trade the TDI with, it's called the shark fin. Some people call it the hook, or I decided to call it the shark fin. So this is pretty easy. It's what happens. It happens that when the green line closes beyond the Bollinger Band, and also closes beyond the oversold or the overbought zone, and then it forms some sort of a shark fin. You know, shark forms the fin, so you can see the fin. Remember, if you're in an ocean in the water, you can see the shark, some shark fin floating above the water. That's what this just looks like. You see the fin outside of the water. So when you spot this shark fin, it's very important that you wait. You wait for a pullback to happen, because it doesn't mean when you see this shark fin, price will reverse immediately. Remember, Forex is all about patience. So it's important you wait for a pullback to happen, and also be on the lookout for divergence. Because if you look at this, this is a good example of the bearish of the bullish divergence. I'm trying to explain that using the USD against the CHF. Now look at this. There was a shark fin here. You can see this. Boom, the green breaks out of the Bollinger Band but goes back in. Now, if you had waited, you see that price came back to that zone. And if you look at your maybe M15, you see it clearer that this low, if you even clear here, this low on the price action on the price chart, actually the same low with this previous low. But on the TDI, you can see that this point is higher than this shark fin. So simple. At this point, you get in on a buy, and then boom, you have this happen. That is happen. So you can either close when the the green line crosses the red line once again, which happened around here. It could have been here, or you secure your trade, put your stop loss at break even, and then enjoy a long ride. So guys, that's pretty much it. TDI is very easy to use. Go over these examples I've given over and over again until you master them. And among all 5 of them, it's good to know all so you can use them at every point you spot a good setups with them, or use a combination of them to for further confirmation of your trade. So that'll be it. If you do not understand, I don't even mind doing this video over again. If you have questions, hit me up in the comment section, ask your question, and I'm going to definitely reply you. So, and if you want to join our group, do not forget to indicate, and I'm going to add you up. I'm going to send you the link to join us on Telegram, where we share ideas together and we'll make money. So thank you very much. I hope this video has added some value to you. If it has, do not hesitate to, do not forget to do the quick taps, like and subscribe. You're going to have yourself some awesome years ahead to come. So guys, thank you very much. Remember to stay safe and take care of yourself. Bye.